Hey, what's going on, guys? It is Forex Warfare here coming back with another video, and I'm going to be talking about what Forex is and why people love Forex and a lot of things that you guys can use for your Forex trading. So, why people love Forex is actually pretty good things over here. So you can always start with $100, and until the early 2000s, it was always not impossible to trade forex markets with anything less than 10,000. So the minimum was 10,000 back in the early 2000s, which was pretty crazy. And you can also work while laying in a hammock. You can literally trade forex markets while sleeping, sipping on a cooler drink, and laying in a hammock. All you need is to get started is some capital to trade with, a computer, laptop, or smartphone, and an internet connection. Don't get me wrong. You decide when you want to trade and therefore your working hours. So no crisis is even during a financial crisis. You can still make money trading forex markets. Any oscillation in the currency can be taken advantage by going long or going short. So whether a market is bullish, over here there's a mistake. They have made a mistake. This the bullish means it's going up, or bearish, which means it's going down. You can trade either way with the forex, unlike stocks or any financial instruments. So you can also learn from pros with social trading, and you can watch what professional traders are doing and observe their trades with social trading. Social trading lets you copy other traders' strategies, can be very beneficial to newcomers, shortening their the learning curve. In the past, traders relied on fundamental and technical analysis, but with social traders, you can take the cues from successful traders to make money on forex if you're a busy guy. And there's a lot of easy rules on the forex markets. It's pretty straightforward as compared to the other financial markets. With stocks, you have to analyze company reports and choose from thousands of companies to invest in. However, forex markets generally revolve around eight currencies known as the majors. Put simply, the better currencies country's economy is doing, the better we expect their currency to perform on the market. So what is Forex? In the Forex market, there's $5.3 trillion traded daily, making it the most largest and liquidated market in the world. And here I'm going to be showing you the majors, and which is Euro USD, Pound USD, USD Yen, on and on and on. The trade in Forex occurs between two currencies, which is the base and quote, because one currency is being bought and another sold at the same time. So over here is the bid, which is the sell price of Euro USD, and the buy, which is the ask price of Euro USD. And here's the spread, which is pips or points between these bid and ask prices. So the smaller the spread, the more liquid the currency is. I'll speak more about that down low. There's a better way to speak about it. So how to read currency pairs is actually pretty easy. As I said, the first one is the base currency and the second is the quote currency. Over here is Euro USD as it's the most major one. And 1 euro is worth $1.1302, which was when this PDF was made. So it could be different depending on what day it is of the time. Majors are widely traded by beginners and professionals alike. This is because they have the most liquidity in the world, lowest spreads, and the broadest range of movements, too. So, unlike small currencies, majors are generally more stable. The economic political institutions of these nations are generally long established and predictable compared to other nations. So there's also the crosses, the popular crosses, which is the pound, yen, euro pound, CAD Japanese. There's always a cross, and the exotics. I'm not sure if you guys have heard about George Soros, who gained $800 million profit from selling the Thai bet in the 1997 Asian crisis. But it's actually pretty risky to trade the exotics. Don't let the cost put you off, because many of the greatest traders of all time made their fortune with exotics. But it is the less traded and so much more costly to buy or sell. So how to trade if you're a busy person? As I was saying, you can be copying trades. If you want to choose a platform, even if you're a new to forex, there are beginner-friendly platforms like eToro that offer you an interesting opportunity to follow the best traders and copy their transactions. So you follow the top traders and then copy their trades, and then go ahead and learn how they profit and profit yourself from their trades you just copy. So I'll put the link down below for checking out the most copied trader list. I'll put the eToro for that. And as we said, we're going to be talking about the pip and spread, but before we talk about that, I want to speak about leverage. Leverage, which represents a margin trading ratio, enables traders to borrow a certain amount of money that allows them to trade in much bigger deals. Moreover, leverage allows one to trade using more money than they have in their account. Therefore, your leverage is your account balance to place a bigger trade. Currency rates move very slowly. This makes a small trade unfashionable as they only return small profits and losses for every rate pip changes. Therefore, leveraging helps one to trade in larger deals, hence amplifying their potential profits but losses as well. Do not forget that losses as well. So, the pip is the price interest point, which represents the smallest change in a currency pair. Typically, it is the fourth decimal point, although many brokers quote using the fifth decimal. So depending on your broker, it could be different. However, the fifth decimal doesn't really affect the price as it changes really quick. Currency pairs that include the US dollar, a pip is 1 to 10 or of a dollar, whereas when the currency pairs include the yen, so a pip is 1 to 100 of a yen because the yen is closer in the value to 1 to 100 of other major currencies. So pip or point is the fourth decimal for the Euro USD. It's the fourth decimal of the rate. And spread in forex trading, brokers quote the bid and ask price for currency pairs. The bid is the price that a trader can sell the base currency, while the ask is the price they can buy the currencies. So the spread is measured in pips. Most currency pairs is the base currency and quote currency have a pip value equal to that. For instance, take the following quote Euro USD over here, and the spread is 0.02, which equates to 2 pips. So that's the difference between the buy and the sell. So let me go over here to show you it visually. So the spread of pips or points is the difference between the buy and ask. I'm not sure if I said this, but that's what it is. So how leverage works is if you have, let's say, a leverage of 1 to 20 on the account A and leverage of 1 to 200 on account B, and over here there's another visual thing to see. So say on account A you had $100 and account B is 100, same deposit, and the leverage you put is 20 for A and 200 for B. So what position sizes you'd want to do is investment times leverage, which is 20 times 100, 200 times 100, which will equal out to 20,000 and 2,000. And if just in that little change in value of that could equal to make you a profit of $6 or $60 on point B or A. So more leverage, more profits, but more losses as well if you don't know what you're doing. The balance in account is 106 is 160 after that has happened. No need to know that. But yeah, there's also one to trade Forex, which is actually a great strategy that I use because the Forex market is open 24 hours a day, 5 days a week. Trading is not always active during this entire time. Profits are made in Forex trading when traders are bidding on the prices and the market is active. So it is essential that you know the crucial hours and days of Forex trading when traders are the most active. So there's a turnover of $358 trillion every day with the Forex market, Sydney, Tokyo, London, and New York times. The sessions is usually the most active. So the London session is actually the most active, and in the afternoon overlaps as it shows here with the opening of the New York or American session. So at 10 or 11, and during those times, which is 5, 6, 7, 8, 9 o'clock, is the best time to trade on the London session. And the best times of the week to trade Forex is Tuesday, Wednesday, somewhat Monday and Thursday, but just be careful on those days. But Friday morning is actually a pretty good time. Saturday and Sunday, you want to make sure you have no orders up for those because you don't know what's going to happen when the market opens on 6 p.m. on Sunday and the market closes on 4 p.m. on Friday. Don't forget that. So there's also one not to trade Forex, which is never trade on bank holidays, Friday afternoons and weekends, end of December, when angry or frustrated, Asian sessions, release of new events, and the market closing time, and overnight. Never ever trade Forex during those times. So as we said before, I'm going to be explaining to you guys what is the bulls and bears in Forex. So bears is when you think a currency will fall, you sell the currency, you open a short position. When you sell, you are said to be bearish. Bearish candlestick is that's how it looks like, and that's a bearish trend. And a bullish trend can also bounce up, just like how it bounced down here. That's the bullish candlestick. So bull is when you think your currency will rise, you buy the currency, you open a long position. So long means buy, short means sell, and there it says it over here again. I'm gonna be showing you guys a different video on how to read charts in Forex, way better than this. So yeah, thank you guys for watching for this video and have a wonderful day.